I am so excited to talk about one of the biggest names in healthcare today, Johnson & Johnson. They're renowned as one of the best dividend growth investments out there. I'm going to really be analyzing that in today's video. So welcome back, channel. If you're new here, hit that subscribe button. I'm Ken Kernen. On today's video, let's get 20 likes, 20 comments. Help me get towards 2,000 subscribers. And as always, comment what you thought of today's video and what you want me to talk about in future videos. But let's talk about Johnson & Johnson. So their stock ticker is JNJ. They're priced at about $126 right now. They have a market cap over $300 billion at $338 billion. They have a nice PE, 23 with a forward PE, 15, established in 1886, and have a starting dividend yield of 2.86%. So in today's video, I really want to be covering three main questions. I want to figure out who is this company, who is Johnson & Johnson. Then I'll be going into their history with paying dividends, and lastly, I'll be analyzing their ability to pay dividends in the future. Because just because they provide such a great return in the past doesn't mean they'll provide a great return in the future. But we'll really look into that data and trends throughout this video. And as a disclaimer, not a licensed investment advisor, and I'm not your tax advisor. I really want you to use this as a starting point for doing your own research. And to quickly go over again, you already know this, but why dividend growth investing? It's an incredible source of passive income, gives you cash flow, and just helps so much more with flexibility. Dividend growth investing can be incredibly powerful if you invest $1,000 per month with dividend growth stocks at a 7% dividend growth rate, at a 3% starting yield, always reinvest dividends for 24 years, you end up with $50,000 per year in passive income. And if you just live off those dividends for the next 20 years, you eventually earn $100,000 in passive income, in dividend income per year. Now that's incredible. It's an extremely powerful tool, and I'm super interested in dividend growth investing because it allows me to play soccer, lift more, meet Scott Rogowski, and hang out with family. And like I said, make sure to subscribe. We really focus on dividend growth investing. I will talk a lot about data and facts. And then this content is completely free and valuable. So make sure to subscribe. But let's get back to Johnson & Johnson. So should we even be considering looking into this company? So let's check out their starting yield. They have a 2.86 starting yield. I think that's good. That's a good starting point. I wish it was higher, and I'll address that later in this video. They have a huge market cap, $338 billion. They have a good PE ratio, hanging out at 23. Their dividend growth rate is solid, 6%. They have an extremely healthy and, in my opinion, a perfect payout ratio at 52%. Been raising their dividend for well over 55 years. Do we understand the business? Yes, and I'll be explaining it to you to make sure you understand. And can it be disrupted by Amazon? That is actually going to be a maybe. And this is a quick graph of J&J. Like I said, they're currently priced at right around $126 per share. But let's get into talking about their revenue. How does this company make money, and what are their streams of revenue? Are they depending on one main stream or actually a few? So their first revenue source is pharmaceuticals. Now this is for treating all kinds of diseases. They currently do about $36 billion per year in their pharmaceutical segment, and that's out of $76 billion per year they're generating. That's 47% of their total revenue stream. And year over year, they've been steadily increasing revenues. And I think that's a very positive trend you'll see with most of their revenue segments. And it's just really important to be constantly keeping money coming into that business overall. They have huge economies of scale. And then Amazon coming into their space or attacking pharmaceutical distribution and maybe actually producing pharmaceuticals could be something to be concerned about, but absolutely that's one thing with Amazon. They aren't taking effect with that immediately. It's a very distant potential to affect Johnson & Johnson. Their second revenue source is medical devices for literally performing surgeries. They serve so many different medical devices, literally for treating so many different kinds of diseases. This segment does $27 billion in revenue out of $76 billion total, and that's 36% of their total revenue. Now that is incredibly well diversified. To have your second biggest revenue source doing 36% of your total revenue per year, that is huge. That shows why and just how diversified this company is, and that is huge for dividend growth investments. They have plateaued revenue for the past 6 years with selling medical equipment, but it does really provide strong diversification, and some risks could be considered IP theft. And then you just see technology getting more inexpensive. day by day. So it's going to be really important for them to continuously innovate and bring the newest, most powerful technology to the table, to the forefront of medicine, in order to keep a premium, to definitely keep the revenues up. So now let's go into financial situation. I really like to look at a company's assets. I also like to look at their debt and make sure there's not too much. Assets allows companies to pivot, quickly invest, and make key investments to position them for continued revenue growth and strong income overall. So a couple notes on their balance sheet. They have $43 billion in current assets compared to $30 billion in current liabilities. I like that ratio. I love to see that too. Seeing it at 1.5 is okay, and this is just below that. They have $157 billion in total assets, $97 billion in total liabilities. I think that's good. I think that's very good. However, it could absolutely be better. I love to see a 2-to-1 ratio just because it gives the company a lot more flexibility. And if they haven't locked in interest rates, then it could just crush them during a recession. Assets have been growing at $9 billion per year for the past 3 years, and liabilities have been growing at $12 billion per year. Hopefully they can manage liabilities a little bit better, but I really don't think it's too big of a concern. So let's talk about their valuation. Stock has returned 37% in the past 5 years. The market's return almost double that at 67%. For the past year return, a lot of dividend growth investments have been down in the past year, and this Johnson & Johnson is no exception. They're down 8%. The market is up 14%. Year to date, Johnson & Johnson is down 10%. The market's up 4%. And then with regards to the PE ratio, they have a very nice starting PE ratio. They're 23. The industry is at 27. And the market's at 25. For the forward PE, they're right contending with the industry and the market at right around 15. And then for their debt to equity ratio, a very nice low debt to equity ratio, especially when you compare them to industry and then when you compare them to the market. So let's go into the data. Let's check out what is going on with Johnson & Johnson's, their dividend payout, their gross profit, their revenue, and their net income. So as you can see, they have for the past 10 years, they've had a high average dividend growth. That's big. That's an incredible need in order to consider them as a dividend growth investment. They've been increasing net income. A quick note on the data I included in this sheet. I didn't consider 2017 for their net income because they had a huge tax they had to address with the new tax law change, and it wasn't surprising. We knew it was coming, and I think it really distorts a lot of the data that was very helpful beforehand. So their net income has been increasing at 4% on average per year for the past 10 years. That's incredible. Gross profit's been a little bit slower at 2.5% and then slowly increasing revenue. I love seeing that. In my last video, I talked about Pepsi, and literally all three of those metrics were basically at zero or negative. So see Johnson & Johnson still growing, still being incredibly profitable. That is huge. So even in recent years, they've continued to have a very healthy dividend growth. Their net income has been increasing at nearly 10% per year for the past 5 years. Their gross profit has been slowly increasing, revenue slowly increasing. And to really try and compare the past 10 years to the past 5 years, their dividend growth rate has been slowing, but it's been slowing to a much more healthy region. And I think they still have a lot of flexibility in being able to up their dividend. And so net income has been increasing in recent years. In the past 5 years, it's been increasing at a greater rate than the past 10 years, which is incredible. And that is very rare amongst these huge dividend growth companies. And I really want to emphasize how incredible of a dividend payout ratio they've had. For the past 10 years, it's been right at 50%. And for the past 5 years, it's basically been at 51%. That is such a healthy dividend payout ratio. And to be able to maintain that throughout that whole section is so huge, and that gives them so much room for upping their dividend in the future. They've had steady gross profit growth, and then revenue has been steadily increasing as well. So let's go into how long will they actually be able to pay out these dividends. We know who this company is. They're in healthcare. They sell pharmaceuticals and medical equipment. We've determined really what their trends have been with the revenue and net income. And now we're going to be looking at their future ability to pay out dividends. So you'll see this negative number for the number of years until the dividends paid out grows equal net income. Well, this that equation uses some logs, and so essentially it is saying that if net income grows at basically 10% per year and dividend growth rate is only at 6% per year, that means the rate at which they increase their dividend will never catch up to the rate at which their net income is growing, which would be incredible. And that means that there'd be a lot of upward pressure to increase their dividend. So I think that these two numbers are huge. And then absolute worst case scenario, expecting that their net income only grows at 4% per year while their dividend growth rate stays at 7%. They run out of money in 14 years. But based on for the past 5 years, they've been killing it with increasing their net income with that diversification and having a steady dividend payout. So overall, I think that they really need to keep steady growth with that dividend. Continue innovating is key to keep that high price equipment and innovation and that demand. And that'll absolutely be critical for their success in the long run. So let's talk about the success of Johnson & Johnson and would I consider investing. Well, we know who they are. They have an okay starting dividend yield. I think if the company dipped recently, I absolutely would be taking a huge position in this company. I love their trend in paying out dividends. I love their payout ratio. They have very solid growth of net income, and their economies of scale are huge for this. Personally, I would buy. Now, I'm not a financial advisor. Like I said, I want this to be beginning of your research and determining if this is good for you in your dividend growth portfolio. They're an incredible backbone to a dividend growth investing portfolio right now, just because they're so well diversified. They're in an industry that's going to be around forever. People are going to be sick forever. They need incredible medical equipment. They need incredible pharmaceuticals to continue surviving. And with more people being born nowadays, can't hurt to have be dominant in the healthcare industry. So let's go into what would happen if I invested. I put in $1,000 per month in a dividend growth portfolio by buying Johnson & Johnson. So I put in $12,000 per year, and then I invest, say that Johnson & Johnson has a starting yield of 2.86%. Say their dividend growth rate based on the past 5 years, it was 6.35%. Let's say they maintain that dividend growth rate, and we keep investing $12,000 per year at that starting dividend yield. After 24 years, we would end up generating $34,000 in passive income, dividend income per year, and that's after tax and inflation. So I think that's very good, and that's why they'd be such a solid. I feel really confident in these numbers, in their starting dividend yield and that dividend growth rate, because there's so much room for a payout ratio. I think that's almost minimum $34,000, because if they continue growing that net income, they'll have an incredible amount of room to really pay out dividends. And then if we decide to start living off those dividends, we stop reinvesting dividends for the next 30 years, we'd eventually hit $80,000 per year in dividend passive income after tax and inflation. So I think overall Johnson & Johnson is a very strong company. Like I said, they sell great pharmaceuticals, medical equipment. Their dividend payout ratio is incredibly healthy right now, only paying out 50% of their net income to dividends. They have tons of room for not only paying out dividends, but for reinvesting in themselves to make sure they stay healthy and innovative with those sectors. And I really don't think Amazon will be a threat in the near future. Maybe 15, 20 years out, they could start directly contesting with Johnson & Johnson. But overall, I do like Johnson & Johnson. I love them as being a position, as a backbone in one's dividend growth investing portfolio. And I really do think you should start doing your own research and determine if they would be a great investment for you. Thank you so much for watching this whole video. I hope you learned something today. I hope this will motivate you to start doing your own research with dividend growth investing and decide if Johnson & Johnson is an investment for you. Thank you so much for watching again. Make sure to like, comment, and subscribe if you haven't already. And I'll see you all in the video next time.